Okay, welcome back. Today, we are really going to dive deep, maybe into a corner of the market you haven't explored much. Business development companies, BDCs.
That's right. And our focus today is a well-known one, Prospect Capital Corporation. The ticker is PSEC.
PSEC, exactly. And look, for you listening, our mission here is pretty clear. We want to really unpack PSEC's whole structure
Yeah, figure out how they actually make money, what their core strategy is.
and why investors find it attractive. What are the advantages? But also, critically, we need to shine a light on the risks. There's definitely skepticism out there.
Absolutely. And you really have to start with the BDC structure itself. It kind of dictates everything.
Right.
These are highly regulated investment companies. The key thing is they have to invest in private middle market companies.
Okay, middle market. So these are companies like too big for a regular small business loan, but not big enough to be listed on the stock exchange.
Exactly that. They fall into that gap. And here's the real kicker, the aha moment, as you called it in the prep.
Right.
Like REITs, real estate investment trusts, BDCs have a legal mandate. They must distribute at least 90% of their taxable income back to shareholders.
90%.
Oh.
Okay, so that explains the high dividend yields you often see with these. It's baked into the structure.
It absolutely is. That requirement is the engine. They must pay out that income to keep their favorable tax status. It's all geared towards current income.
Okay, so if the goal is current income, how does PSEC specifically generate it? What's the actual business?
Well, PSEC's bread and butter is lending. They provide capital, mostly debt, to these U.S. middle market businesses.
Mostly debt, you say. Not really buying ownership stakes.
Overwhelmingly debt. And specifically, they focus heavily on what's called senior secured loans. Think first lien debt.
First line. And when you say heavily, the data shows this is often, what, 80% or even more of their portfolio?
That's right.
A huge chunk. It tells you their priority is security, or at least perceived security,
Right.
over chasing massive equity-like returns. They want that top spot in the payback line. So they're not aiming for home runs like a venture capital fund might. They want steady, contractual interest payments.
Precisely. That interest income is their lifeblood. That's what they collect, and that's what they use to pay out those monthly distributions to shareholders, to you, if you hold the stock.
Okay, that monthly payout is obviously a big draw.
Yeah.
Let's talk about the advantages then. Why PSEC? What makes it attractive to income investors?
Well, advantage number one is right there. The income itself. PSEC historically offers a pretty high yield compared to, say, the broader market.
And a monthly payout is key too, right? Not quarterly like most stocks.
Definitely. For anyone trying to manage cash flow, getting that check every month can be really appealing. It smooths things out.
But okay, they're lending to these middle market companies, maybe companies the big banks pass on. That sounds risky. How do they protect themselves? You mentioned senior secured.
Right, that's advantage two, the secured position. By focusing on first lien debt, they put themselves at the top of the capital structure.
Meaning if the borrower gets into trouble.
If the borrower defaults, PSEC, holding that first lien, has the first claim on the specific assets pledged as collateral. That could be equipment, property, inventory, whatever secures the loan.
So they get first dibs to try and recover their money. That seniority is crucial, I imagine, when you're playing in this riskier sandbox.
Absolutely crucial. It's their main downside protection argument.
But how solid is secured, really, with these types of borrowers? It's still not risk-free.
Oh, definitely not risk-free. Which leads us to a really interesting third advantage, especially relevant recently, the floating rate hedge.
Okay, floating rates. Tell me more.
A big chunk of PSEC's loan portfolio has variable or floating interest rates tied to benchmarks like LIBOR or SOFR.
So when the Federal Reserve jacks up interest rates, like they've been doing,
PSEC's income automatically goes up too because the rates on their loans reset higher. Their assets start generating more cash.
oh, okay. And if PSEC's own borrowing, their liabilities are mostly fixed rate.
Then their net interest margin, the difference between what they earn on assets and pay on liabilities, can actually widen. It's kind of an inbuilt protection against rising rates.
Which is pretty unique. Most fixed income investments get hurt by rising rates.
Exactly. It can make PSEC look like a defensive play during rate hike cycles.
Interesting. Okay, what else? Any other advantages?
Well, there's the access aspect. PSEC allows regular retail investors, folks listening, to get exposure to private middle market credit.
Yeah, that's usually the domain of big institutions, pension funds, endowments.
Right. So PSEC opens that door, and then there's the valuation point. PSEC often trades at a discount to its net asset value, or NAV, per share.
NAV being Just assets minus liabilities divided by shares, the theoretical breakup value.
Pretty much, yeah. It's the book value of the underlying investment.
So if it trades at a discount, some investors think they're getting a bargain, buying $1 of assets for, say, 90 cents.
That's the argument. They see it as a margin of safety, hoping the discount narrows over time, giving them some capital appreciation on top of the dividend.
Okay, so high monthly yield, secured position, floating rates, access, and potential value. Sounds pretty good.
It does lay out the bull case quite well. But like you said earlier, there's a reason for market skepticism. We need to flip the coin.
Absolutely. Let's get into the disadvantages and risks, because that high yield doesn't come free. What are the big red flags?
The number one risk, the one that underpins almost everything else, is plain old credit risk.
Meaning the risk that the borrowers just won't pay back their loans.
Exactly. These are private companies, less transparent than public ones, often carrying more debt. If the economy turns sour, some of these companies will struggle.
And when they struggle, their loans might go on, what's the term? Non-accrual.
Non-accrual status, yeah. That's a critical term for BDC investors.
Explain that. What does non-accrual mean practically for PSEC and its dividend?
It means the borrower has stopped making interest payments, usually after being delinquent for, say, 90 days. When a loan goes on non-accrual, PSEC has to stop recognizing interest income from that loan.
Ah, so the income tap for that loan gets turned off.
Right. And since PSEC's dividend relies heavily on collecting that interest income, a rise in non-accruals directly hits their net investment income, or NII.
Okay, let's define NII clearly. That seems crucial for the dividend story.
NII is basically the core earnings. It's the interest income and any fee income PSEC gets from its investments, minus all its operating expenses, management fees, interest expense on its own debt, administrative costs.
And importantly, it excludes capital gains or losses on the investments themselves.
Correct. It's the recurring operational profit. And PSEC needs that NII to be high enough to cover that big dividend payout, that 90% distribution requirement.
If NII falls short,
then they might have to rely on selling assets for capital gains, which isn't sustainable long-term, or the dreaded option, they might have to cut the dividend.
and PSEC has cut its dividend in the past, right? Although it's been stable for a few years now, since 2017, I think.
That's right. Stable since 2017, but the history of cuts definitely lingers. It means investors are always watching that NII coverage ratio very closely. Is the income really enough?
Okay, so credit risk feeding into dividend sustainability risk. What else?
A major concern for PSE specifically has been the long-term trend in its net asset value, NAV, per share. It has, historically, struggled to maintain or grow its NAV.
Meaning the underlying value of the company on a per-share basis has been shrinking over time.
Often, yes, or at least not growing consistently. This NAV erosion is a fundamental critique.
Let's hammer this point home. Why is declining NAV such a big deal if you're getting a fat dividend?
Because total return is what matters. Total return is your dividend yield plus the change in the underlying asset value, the NAV change.
Right.
If you're getting, say, a 10% dividend, but your NAV per share drops by 12% that year because of bad investments or maybe management fees.
Your actual total return is negative 2%. You're losing money overall, even with the big dividend checks.
Precisely. The dividend in that scenario isn't really earned income. It could be partly a return of your own capital, masking the underlying value destruction. You're getting paid, but the pie is shrinking.
Okay, that's a critical point.
Yeah.
And what drives that NAV erosion? Is it just bad loans?
Bad loans are part of it, sure. But another huge factor often cited is the external management structure. This gets a bit complex, but it's vital.
Explain that. PSEC itself doesn't employ its managers directly.
No. PSEC is managed by a separate company, Prospect Capital Management, which is an external entity. PSEC pays this external manager fees for its services.
And why is that structure potentially problematic?
It creates a potential conflict of interest. Unlike an internally managed company where the managers are employees whose success is usually tied to things like NAV growth per share, external managers often get paid a base fee calculated as a percentage of the total assets they manage AUM.
I see where this is going. If my pay depends on the size of the fund.
Your incentive might be just to make the fund bigger and bigger, right? Grow AUM, because bigger AUM means bigger fees for the management company.
Regardless of whether growing bigger actually helps the existing shareholders on a per-share basis.
Potentially, yes. It could incentivize the manager to, say, issue new PSEC stock, maybe even at a discount to NAV. just to raise cash to buy more assets and pump up AUM.
which dilutes existing shareholders and pushes NAV per share down further.
Exactly. Or it might incentivize making riskier loans just to deploy capital quickly and grow the asset base, rather than focusing purely on the best risk-adjusted returns for the shareholders. It's a structural misalignment of incentives that critics point to constantly.
Wow, okay. That external management conflict seems like a really core issue that could tie into both credit quality and NAV erosion.
It's often seen as a root cause, or at least a major contributing factor to some of PSEC's historical challenges.
Any other risks we need to mention?
Just briefly, the illiquidity of the underlying assets. These aren't stocks you can buy and sell easily.
Right, the loans and private equity stakes PSEC holds aren't traded on an exchange.
So valuing them can be subjective, relying on internal models. And if PSEC ever needed to sell assets quickly, especially in a stressed market,
They might not get the value listed on their books.
they might have to sell at a significant discount, which could crystallize losses and hit NAV even harder. It adds another layer of uncertainty.
Okay, this has been quite the deep dive. We've really seen the tension here.
Definitely.
On one side, you've got PSEC offering this really attractive, high monthly dividend yield as driven by the BDC rules.
And supported, theoretically, by focusing on those senior secured loans and benefiting from floating rates when interest rates go up.
Yeah, that floating rate aspect is quite compelling in certain environments.
But then, casting a pretty big shadow, you have these significant risks. The fundamental credit risk of lending to middle market companies.
The history of dividend cuts, reminding you that the payout isn't guaranteed, you have to watch that NII coverage.
And maybe most critically, that persistent struggle with NAV erosion over the long haul.
Often linked back to that external management structure and the potential conflicts of interest there. It really complicates the picture.
It does. You really need to understand how that BDC structure, designed for income, also influences the risks, and how that management relationship plays into the potential for long-term value creation or destruction.
It forces you to look way beyond just the headline dividend yield number.
Absolutely. You have to consider the total return potential, warts and all.
So we'll leave you, the listener, with this to think about. Given PSEC's documented history of NAV per share erosion, and considering that structural risk where the external manager might be incentivized more by asset growth than by per-share returns,
Yeah.
how much long-term capital appreciation are you potentially giving up or even sacrificing just to get that very tempting high monthly dividend payment today, something to really mull over?